My name is Jake, welcome to the channel. In today's video, I want to talk about should you invest into SPYI and QQQI as a dividend investor. If you are familiar with the space when it comes to covered call ETFs, I talk about them quite a bit here on my channel. These are new covered call ETFs that have just come onto the market here in the last year or so, and they've gotten very popular in a very short period of time. And I think a lot of that has to do with the ticker themselves, the name that they went with, SPYI. I mean, everybody knows SPY and QQQ. So I have some thoughts on that as well that I'll get to in a second. But these are covered call ETFs. These are income-oriented ETFs. They're not like traditional ETFs like, you know, the total US stock market or dividend-focused ETFs that track a dividend-focused index. This is an actively managed index, and I want to break down kind of what these ETFs are and, you know, what my thoughts are on them. And, you know, ETFs like this, I own similar ETFs in my dividend portfolio. What you're seeing on your screen is my M1 portfolio. This is my dividend portfolio that I'm currently living off of in what is called Barista Fire. So if you're new to the channel, that's a little bit about me. But here in my dividend portfolio, some of my largest holdings are actually covered call ETFs. And then it has to do with my time horizon where I'm actually living off of my dividend portfolio. And so you'll notice the largest position in my portfolio is actually JEPQ. This is a covered call ETF that tracks the NASDAQ. This is from JP Morgan. I also got VYM, SHD in here, and I have JEPI. These are really popular ETFs that have popped up here since the pandemic in the last couple of years. And they're really the main focus of these ETFs, the covered call ones, right, from JP Morgan, is really to provide an investor with income today. It's not really a growth index or a growth strategy. It's mostly focused on income. The reason for making this video was I got an interesting email here and I wanted to share that with you, and I'm excited that this person reached out, because if it wasn't for them reaching out, I wouldn't be making this video today. So the person wrote here an email. They said, "Hey Jake, I was wondering if you could do a video on the new dividend ETFs SPYI and QQQI. They're obviously brand new and there's not much info out there yet, but if you could help simplify it, that would be great. What are these funds for? Would they be part of a well-balanced portfolio? If yes, how would you recommend that someone invest in these funds and in which account? I'd love to hear your thoughts on these. Thanks again for everything that you do. I hope you and your family are doing well. Liz." Well, Liz, this is a really great question. I'm glad that you're reaching out and that you're not just blindly going and, you know, maybe following the herd when it comes to, you know, maybe other YouTubers out there who are talking very highly about these ETFs. I think, you know, I've prepared for this video. I've done my research. And so I want to share my thoughts and opinions, which are more subjective, but I want to share more objective findings that I found about these ETFs and some things to kind of look out for. So, you know, what are these funds for? And I'll get to that here just in a second, but just to give you a snapshot, these are income focused funds. So if your time horizon where you're looking to live off your portfolio, the income from your portfolio, if your time horizon is greater than 5 years, you can disregard these entirely. These are not for you. Okay, these are income funds. These are funds where you're going to live off the income and not the growth. Okay, so very, very important. In terms of a well-balanced portfolio, 100%, I think everything should be under the consideration of a well-balanced portfolio. So that goes regardless, you know, beside the point. So that's very, very important that you, whatever you do, you have a well-balanced portfolio. And that's why I talk so much about the simple path to wealth with dividend investing, which was inspired by J.L. Collins, that I talk on my channel, by, you know, having a core portfolio, a dividend portfolio of SHD and DJRO. That's what I talk about on my channel. But, you know, if I were to recommend these, you know, funds to someone, obviously they would be the best to have in a tax advantaged account like a Roth IRA. But if you are retiring early or, you know, semi-retiring early like Barista Fire, like I did in my 30s, you could have these in a taxable account. That wouldn't be the end of the world. But yeah, Liz, thank you so much for sending over the email. It's really great to see more female viewers watch my channel, because most of the emails that I get are from dudes. And I think like 99% of my viewers are dudes. And we all know what dudes are like, and it could look a little like this. Heaven must have sent you.
देख आदर्श ऐसे रहना, ठीक है? हाँ, प्रॉपर तेरा शेप आएगा। मैं देखता हूँ।
Listen, did you know that in 1969, 4 people were killed during the Rolling Stones concert, but the overall population of the concert never changed because 4 babies were also born? Now you do.
Oh my gosh. Oh man, I love it. The thing that I love most about dudes is that we're so stupid. Like we can laugh at ourselves just being completely ridiculous. But I'm not saying that girls can't do that as well, but I think it's very clear when you watch a guy do something stupid, I think the normal reaction is to just shake and nod your head. So to start off, there's some really great articles for and against these ETFs. These are income-focused ETFs. One, for example, here from Steven. I've actually spoken with Steven. I actually like him. He speaks very favorably of these ETFs. Steven is someone that I follow here on Seeking Alpha. He's a great follow if you like reading about income strategies. He speaks very favorably about SPYI and same for QQQI. And, you know, there's a lot of things to like. There's a few things to kind of scratch your head on, and we're going to touch on that. So let's take a look at this here just briefly, just some overall things that I look at when I'm considering an investment. The first thing that I'm looking at is I'm looking at the expense ratio. If this is an ETF, the expense ratio is fairly high. It's not on the higher end. You know, for example, when QYLD first came out, I think it was right around 68%. It's kind of ironic that they chose the exact same expense ratio. It's as if they were watching QYLD or XYLD. Since then, Global X has lowered their fees. I think it's like 0.61%. So a couple of things here. So SPYI is from Neos. This is a new company that was just founded here a couple of years ago, like 2 years ago. So really just a brand new company. And this ETF is tracking the S&P 500. And what that means is it's an actively managed fund, but they still track the S&P 500. But the active part comes with the derivative strategy where they're writing call options, but they're not writing them on all individual holdings at the same time, which we'll get to in a second. So this one is tracking the S&P 500, very similar to JEPI from JP Morgan, almost identical in terms of the strategy. Oh, for the most part, not exactly, but very, very similar. So when you're thinking about this, think of JEPI when you think of SPYI. The next one here is QQQI, once again, also from Neos. It has the same expense ratio here, fairly high of 0.68%. Just to put this into context, this is about double what the JP Morgan JEPQ ETF is. Okay, so it's the same thing with JEPI or JEPQ, where it's tracking either the S&P 500 or the NASDAQ, okay? But don't get confused because it's not a passive index, it is an active index, okay? So that can be a little bit confusing because with a passive index, it's just following the rules of a designed index or defined index. With an actively managed index, the fund managers are really the ones pulling the strings and deciding what they're going to do, and it's not following any specific rules. You know, it's more focused on what are the fund managers doing in that point in time. Okay, so that's very, very important, fundamental that you understand the differences here between, you know, a covered call ETF and maybe an ETF like SHD or DGRO. Now, to be very objective, since SPYI has come out, the total return over the last year has actually been fairly decent. If you compare that just with the S&P 500, this is if you were to invest in SPY or VOO. This is with the dividend reinvested. It's done pretty well. It's outperformed JEPI and XYLD on a total return basis. So in terms of performance, it's done better than other cover call ETFs. Now, if we compare the exact same thing with QQQI, this is tracking the NASDAQ, you can see here that QQQI has slightly outperformed the QYLD, underperformed JEPQ, but I don't really see this as representative of anything. This is only like, 3 months of data? Okay, the next thing that I want to talk about is the company itself, because as I mentioned, this is an actively managed fund. So you're not investing into the rules of an index. You're actually invested in the people behind the index. Okay, do you understand? Do you follow me? So when you invest into SPYI and QQQI, essentially you are investing in the people right here. Okay, do you understand that? That is so important that you understand this. When you're investing in this ETF, you are investing into Garrett, Troy, and the others here that you can see on your screen. Okay, these are the founders and the management team of this ETF. Okay, and because this is an actively managed fund, they decide what the fund does based off of how they set it up. But essentially, when you invest into an ETF like this, you're investing into them. And this company has been around for a whopping 2 years. So they've obviously been in their careers much longer than 2 years, but the company has existed for 2 years. So that is something that you want to keep in the back of your mind when you're putting your hard-earned money into an ETF. Understand that this is who you're invested in. The next thing that I wanted to show you is from their website that they very clearly are trying to achieve a comparison of other like-kinded ETFs, like QYLD, XYLD, JEPI, DEVO, SPY, and their target market is very defined. They're going after investors who are already investing in a JEPI, DEVO, or XYLD. What they're doing, what these guys right here, so this company's been around for 2 years. They're seeing all of the success of QYLD from Global X and JEPI and JEPQ from JP Morgan. And these guys are saying, hey, there's a market for this, right? There is a market, a need, or a demand for these type of services and products, because these are products. And this company was recently put together and they are bringing this product to market and they're marketing it to investors like you and I. And this is what they're trying to help you understand. This is what they're trying to sell you. They're selling you the idea that what their product does is similar to what you already know. Okay, and that's important that you understand that, because when you look at the literature and you look at their marketing on their website and on their YouTube channel and all of their collateral, like their marketing collateral, it's very clear what they're trying to do. I have a marketing degree. I have a master's in marketing. I know what they're doing. And it's so very obvious. Take that for what it is. They have a clear mission. What they're trying to do is access a market that already exists from these other ETFs, and they're trying to steal market share or assets under management, investment dollars from you and I. And, there's nothing necessarily wrong with that if they provide a great product, but it's important that you as the consumer understand what's going on here. Okay, let's take a look at this really quick. This is the fact sheet for SPYI. They do not have a fact sheet for QQQI. Once again, it's a brand new ETF, but essentially what they're saying here is that the focus of this is a high monthly income generation, right? That sounds like what every retail investor wants. High monthly dividend income, right? Who doesn't want that? SPYI aims to generate high monthly income by investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. Okay, that's cool. This one is a big one for them, is the tax efficiency. SPYI utilizes the SPX index options classified as section 1256 contract, 60% long-term, 40% short-term. Who of you watching this video understands that or knows what that is? Essentially, they're leveraging a tax code in the IRS tax code for their benefit, and it could work out. It could also not work out. But essentially, that's what they're doing in layman's terms. And the fund managers may seek to take advantage of tax loss harvesting opportunities. This is a big one. This is a big thing that they, when doing my research, this was like their big USP. Their unique selling point was on the tax efficiency. And we'll get to that here in a second. The next thing is there's a focus on potential lower volatility. That is absolutely true with these type of strategies. JEPI is an example, is very similar. And professional options management leverage the deep expertise and research of NEOs, combining decades of experience managing options-based ETFs. Okay, that's cool. So once again, guys, what you're getting in this ETF, this is a byproduct, the tax efficiency, the monthly income. That is all a byproduct of this right here. This is what you're investing in. You're investing in the people behind the ETF. Okay. And that is what you absolutely have to understand. I've watched a few other YouTube videos in the past on these ETFs. A lot of people don't really understand this. A lot of people here on YouTube, you have to understand what you're invested in is this right here. And because I'm a nerd and I wanted to make sure that I'm looking at this correctly, I went into their prospectus and I took a look at their fund strategy. And I want to briefly highlight this just to make sure that we're looking at this the right thing. So this essentially, what we just saw is a summary of this. Okay, so and it seeks to achieve its investment objective by investing in a portfolio of stocks that make up the S&P 500. Okay, we know that. And a call option strategy which consists of a mix of written sold call options and long bought call options. Wait, it didn't say that it was doing bought call options before. Anyways, let's continue. Under certain circumstances, the call option strategy may include transactions with covered call options. The fund seeks to generate high income from premiums earned from the SPX call option as well as the dividends received from the fund's equity holdings. So this is really important, guys. So essentially what you're getting is you're getting the premium, the options premium income, which is not a dividend, as well as the dividends received. So the fund owns the whole S&P 500. So you're getting the dividends from the S&P 500, but on top of that, you're getting the distributions or the premium income. This is the exact same thing with JEPI and JEPQ. The SPX call option seeks to generate a net credit, meaning the premium received from the sale of the call option will be greater than the cost of buying the long out of the money SPX call option. Okay, so this is kind of like their buy and sell strategy there. Okay. The SPX option strategy is intended to generate high monthly income in a tax efficient manner with the potential for upside participation when the underlying equity index appreciates. The fund seeks to track tax efficient returns by utilizing index options. Okay. So this is what we're talking about with this section 1256. Essentially, it's a split between a 60% long-term and 40% short-term. That's all well and good. Sounds good. The fund may seek to take advantage of tax loss harvesting opportunities by taking investment losses from certain equities and options. Okay, so they have a little bit more they have a little bit more flexibility when it comes to this, and they're a little bit more hands-on with the tax efficiency. All of that sounds okay. That sounds interesting. Okay, good. Now moving on to the other one, QQQI. Essentially, is pretty much the exact same thing that we just read, except what I'm not seeing on this one is with this strategy, they're not doing the buy option. So they're not buying. Let me see. Wait, actually, the advisor may, under certain circumstances, enter in a call spread strategy where it purchases long bought calls. Okay, so actually, yes, it does. So it's essentially the exact same strategy for both funds where they have the option to do a call spread strategy. I guess that's fine. I mean, yeah, okay, it is what it is. It's a little bit more active than with JEPI or JEPQ. Okay, so now I want to walk you through the tax implication here. So a large percentage of their distributions are going to be classified as return of capital. And in doing my research, looking on their site, like they are very, very open about return of capital. This is something that QYLD did very poorly, where they led investors to believe that it was going to be a return of capital, and then it wasn't. And a lot of investors got burned on their taxes and did not like that. And so they, like I said, they're very much copying, I guess, the same approach as QYLD. Let's say they gain inspiration. They gain inspiration from QYLD, so I don't make any accusations. That they're looking at how these other ETFs did it, and they're doing it their way. But what I want to show you is actually show you the breakup between long-term, short-term, and return of capital. I didn't see a year-end total of all distributions, so I'm just going to show you a few of these. So if you were to invest into SPYI for the entire year of 2023, so if we look at this here for January, you'll see here that 91% of the distribution was classified or is estimated. I'm not so estimated. Is this fully accurate? This is where QYLD messed up, is they said estimated, but it was totally off. I think this is what, I don't know if this is, you can really believe this. You'd have to look at your 1099 dividend form, but okay, whatever. Let's just assume this is correct because I can't say otherwise. So let's just use the example. Let's say you invested $100 in this ETF, and let's say you got a $10 distribution, like in the form of a dividend. Well, that $10 was, nine of the $10 is just being returned to you of your initial $100. So instead of having invested $100, you now have only invested $91. So all they did was return your capital and call it a dividend. Do you understand that? They're just giving you back your investment. Now, there is a tax benefit here because in the year that you receive the return of capital, the money, you're not going to pay any taxes on that. That's great. But let's say next year you decide to sell it. Well, your cost basis is no longer $100. Your cost basis is now $91. Do you understand? The tax man is going to get his, right? You're not going to screw the tax man. Okay. So you might be deferring the tax, but you're not quote unquote saving on the tax entirely. It's just a deferment of the tax. And that's what you have to understand about these ETFs. And the bells and whistles and the beautiful marketing of, oh, it's great, it's tax efficient. You need to really understand what you're getting with these ETFs. So I hope that for hundreds and thousands of you hopefully watching this video, that you just got the light bulb and you're like, oh, that's what it is. Okay? You following me? Okay, cool. Let's take a look at a few other of these just to see, okay, here in February, 90% return of capital. Let's see in March, 90% return of capital. April, 92% return of capital. May, 91% return of capital. They love returning your original investment back to you and calling it a dividend. Let's look July, 96% return of capital. August, 94%. And in their marketing, they always say, yeah, we could potentially do return of capital and it might be part of the strategy. No, that looks like BS to me, dude. 93% is not a little bit of return of capital. 92% is freaking 92%. All right, so that was SPYI. Let's look at QQQI. This was, it's been around this year. 97%. Are you kidding me? 97%. 97%. What is April? No, 100%. Once again, this is estimated, so they could throw a fastball on you. No, so the tax efficiency, that looks more like a wolf in sheep's clothing, if you ask me. So for me, that gets an F grade, in my opinion. The advantage of tax efficiency, no. Okay, so that's tax efficiency, that's taxes when it comes to these ETFs. Before I forget, let me show you the distributions, the dividend. So you'll see here that the fund has been around for about a year at this point, and so the forward dividend yield is around 11.5-ish%. Now, this is something that's really interesting that I think you kind of got to make sure that you are aware. So you see here that they have the same dividend almost every single month, or the same distribution, and they're able to do this because of what we just saw with the return of capital. They're just returning your capital to you and wrapping it up in the form of a quote unquote dividend, which is actually a distribution, right? At the end of the day. And so this right here, I'm not like, when I look at this, if you're a new dividend investor, and that's why I titled this video, should you invest into this as a dividend investor? I can see the appeal. If you're new to dividend investing, I can really see the appeal of, you look at this and you think, oh, this is amazing. But I think there's a lot of things to consider and look under the hood before blindly investing into an ETF like this. Now, I want to circle back to what I was saying earlier with the most important thing to consider with investing into an ETF like this. I mentioned time and time again that you're investing into the company or the fund managers, not really the ETF itself. So it's important that you understand that. And this company, Neo's Investments, it's from Connecticut. They got 13 people working at this company. So by my definition, this is founded in 2022, 13 people. This is like a really, really small startup. Do you want to throw all your money into a startup? I don't know, but it's important that you understand that don't just look at the ticker, don't just look at the investment, like look a little bit further and see what are you actually getting. Let me take a look and see what he's got here. So he's been in the company, he's a co-founder for the last 2 years. He has great experience. He's worked at another investment firm. He's been a managing director. He's probably very well educated. I mean, he's as old as I am, so as old as me. He's in his late 30s. He's been working for about as long as I have. Yeah, I mean, he's got great experience. Seems like a nice guy. He's got a nice smile. Look at that. When you invest into SPYI and QQQI, you're investing into Garrett. The next one here really quick is Troy. Troy, look at that smile. He looks like a nice guy. He's probably a nice guy. I don't know. You got, so co-founder, managing director, okay, great, executive director. He's a little bit older. I mean, that doesn't always mean everything. But essentially, they worked at other companies before, and now they've decided that they want to be their own boss, and they started their own investment firm. It's important to understand when you invest into these ETFs, this is what you're investing. You're investing into Troy. So now that we've talked more about the objective side, I want to kind of switch gears here and go more into the subjective side and share my thoughts and opinions on what I like and what I dislike about these two ETFs. So the first thing that I like is that the ETFs are reasonably priced. The expense ratio of 0.68% is reasonable for an actively managed fund. The expense ratio may be warranted due to what you're getting. You are getting quite a bit for what they're claiming to be doing. By comparison, if you had a fund manager, maybe you went and you saw a financial advisor or went to an investment firm to perform a similar strategy, a call right strategy, right, where you're generating options premium, it's unlikely that you would get a lower fee than what you would get with SPYI and QQQI. So I think the value in terms of what they're providing, the fee may be justified. The next thing that I like is I like their call option strategy where they don't write options on every single stock all at the same time, which will allow for potential upside. So upside potential. I do like that. They do mention that in their fund literature that, if they have 500 S&P 500 companies in there, they will strategically write options on a handful of them, thereby allowing for more upside potential. I do like that piece. And you're also going to get more of a regular dividend that way. So there is some tax efficiency there. I do like that. The third thing that I like about these ETFs is I like their call option strategy where it's focused on out of the money. Now, this is really, really important. This is different than QYLD where, they're selling it at the money. This is allowing for in a bull market, you're going to have the potential. It's all about the potential for upside growth. So in a bull market, you will participate in the upside. In a down market and a flat market, it won't really matter, but in a bull market, it will matter. The fourth thing that I like about these ETFs, and it has a little bit more to do with the company itself, is I do like that they're upfront about the return of capital, though they may downplay the negatives or the potential negatives, and they mostly only focus on the positive. So I watched all of their videos on their YouTube channel. I read their fund literature around the return of capital and the strategy there. They're very, very selectively optimistic. I do like that they're, addressing the elephant in the room when it comes to this. I do believe, though, that they kind of are downplaying it. So it's kind of a like and dislike at the same time. The last thing here, the fifth thing that I like is I'm impressed with their total returns since inception. This, when looking at SPYI, it has done very well. And at the end of the day, performance is all that matters, right? Opinions of some random dude on the internet don't matter as much as the actual performance, okay? Because it is actively managed, that performance will, depend year over year. This, just because it outperformed one year does not mean that it will outperform the next. But I do like their total return performance. All right, now let's talk about some things that I dislike about these ETFs. And this is just having done the research myself and looked at it. And the very first thing is their marketing feels like they're trying to sell you a dream. Right? High monthly income, and without any consequences, the market only goes up, essentially, right? And it reminds me a lot of the ARK funds in 2021. Innovation only goes up in a straight vertical line, right? There's never a down market, and there's never a downside to anything. And so when you do your research and you look at their marketing, it really feels like they're selling you a dream. And I don't like that as an investor. I think just be real, and it doesn't feel like they're really real. But that's, once again, subjective, my opinion. The second thing that I dislike is they really are selling you the illusion of a growing dividend yield or through the return of capital, I think is really what I dislike. You saw the dividend, the high income. it's just completely flat because it's all return of capital. So I was not really a big fan of the illusion of the yield. And that kind of ties into the third here, which is the illusion of tax efficiency being the return of capital. Just because you're returning capital to keep the distributions equal or high, kind of similar to QYLD, it doesn't mean that it's tax efficient, and it doesn't really mean that it's a good investment. It depends on the person, obviously, the investor and their situation. But I really feel that comes into the first one, the dream or the illusion of they've cracked the code or that they can do it better. So I'm not the biggest fan of that. I don't like that. The fourth thing that I was not the biggest fan of, and this kind of ties into, the taxes as well. When I was doing my research on the site, like the examples that they give was really just talking about only the positives of their tax efficiency strategy and the return of capital not eroding your investment, and that it's not really applicable in bear markets. The examples that they gave, it was just all like, the world is all rainbows and unicorns. And we all know that the reality of the world is not like that. So I was not a big fan of that. And then the fifth thing here is that, it feels like they got fake or a shady brand awareness with using the QQQ and the SPY symbols. Everyone and their dog knows QQQ and SPY. If you invest in the stock market, you know those tickers. And by tacking on the I at the end of these tickers, you immediately gain brand awareness. Now, I've worked at a startup. I know how hard it is to get recognition as a startup. I worked as a sales rep at a startup. You know how I started every one of my sales calls? I referenced big name customers that we worked with. We worked with BMW. That was one of our biggest, largest companies, one of our only. But because I referenced BMW, I bought myself credibility and trust. And what it feels like is they're building trust with investors by leveraging the name QQQ and SPY. And I don't really fault them. I mean, they're a startup. I understand why they're doing it, but you as an investor have to understand that they're leveraging the trust of QQQ and SPY, and they're by association trying to kind of weasel themselves into that, established trust with those symbols. Do you understand what I'm saying? It's kind of shady. So I'm not the biggest fan of that. Another example, there's those other ETFs, JEPY, JEPY, just copying the JEPI. These funds, they do it all the time. And when I see that, it leaves a bad taste in my mouth. So for that reason, I do not like it. The last reason why, or the last dislike that I have for these ETFs is the company's a startup. I don't trust startups with my hard-earned money. And, maybe in a couple of years down the road, after they've proven themselves, maybe I would consider it. But as it stands right now, I worked really hard for my money. I'm not about to go and take a chance on a company that's been around for 2 years. It's just not something that, for me, it's like, why would I risk it? There's no need to take on the extra added risk. But if you are someone who's like, hey, you know what? I really like the strategy. I really like, the management team. Okay, that's cool. Someone who should consider investing in these is if you're looking to gain more exposure to an active management approach, to your portfolio. Let's say, for example, you only have passive index funds and you want to add in a layer of active management. Hey, this might be something to consider. Another reason or another person who should consider investing in these ETFs, because it is a startup, your middle name is Danger, because you're willing to take a risk and trust the founders of this new startup company with your money, because you like to live life dangerously. And there's nothing wrong with that. But yeah, I mean, if you absolutely like the strategy, you liked what they're doing here, and you buy into their story, then I could see these as a small satellite position, maybe 1 or 2% of your overall portfolio. I really wouldn't invest more than that. I would wait and see how the tax implications are set up, how they manage that. But overall, yeah, I think, most people would be better off sticking with JEPI or JEPQ. For the meantime, staying on the sidelines, watching what these ETFs do. You're not going to miss out, guys. You're not going to miss out. You're always going to be able to get back into these at a fair valuation. The market does not always go up, and these ETFs, they come and go. And so I would definitely recommend not FOMOing into an ETF like this. No matter how much somebody pumps it on YouTube, just do your research. So yeah, I hope that the video was helpful for you. Hope you learned something new. And do you agree? Do you disagree? Am I missing something? I'd love to hear your thoughts and opinions in the comments. And I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.